Have you ever bought a stock and then immediately started worrying about a market drop? Well, today we're going to talk about a really powerful strategy that can help shield your investments from those sudden shocks. It's called the protective put, and honestly, the best way to think about it is like insurance for your stock portfolio. I mean, we've all been there, right? You're feeling good about a stock you own, but in the back of your mind, there's that little voice worrying about a sudden downturn. This is exactly where the protective put comes in. It's designed to give you some real peace of mind. So, how does this insurance policy actually work? At its heart, it's a pretty straightforward two-part move. First, you own the shares of a stock. And second, at the same time, you buy what's called a put option for those shares. Just think of that option as a contract that gives you the right to sell your shares at a pre-agreed, guaranteed price. It's your safety net. Okay, theory is one thing, but let's make this crystal clear. The best way to get it is to walk through a simple, real-world example with some actual numbers. So let's imagine you buy shares in a company. We'll call it ABC, for 1,000 rupees a share. Now, to protect that investment, you also buy a put option. This sets your strike price. That's your guaranteed selling price at 950 rupees. And the cost for this protection, what we call the premium, is just 20 rupees per share. That's the price of your insurance. All right, you're all set up. You've got your stock, you've got your protection, but here's where this strategy really shines. What happens if the market takes a nosedive and that stock price starts to plummet? This is your safety net in action. Look, even if that stock completely tanks, your put option guarantees you can sell your shares for 950 rupees. So your maximum loss is super easy to figure out. It's just the 50 rupee difference between what you paid and your guaranteed sale price plus the 20 rupees you paid for the insurance. That's it. Your loss is capped at 70 rupees a share no matter how low the stock goes. Your risk is completely defined. And, this really gets to the heart of a core principle of professional investing. Profits, they can be uncertain. Nobody knows the future. But your risk, that should not be. By defining exactly what your downside is from the very beginning, you're not just playing defense. You're making sure you can stay in the game for the long haul.